Hi, this is Mike Larson from Money and Markets TV. Thanksgiving is supposed to be about celebrating with family and friends, watching football, and falling into a food coma. But unfortunately, a lot of investors are suffering from much worse than indigestion right now. They're loaded down with debt investments that are blowing up, and more indicators in the credit markets are flashing red. Consider the case of the European Investment Bank, or EIB. It generally lends to development programs such as reforestation or public works for underserved countries and communities. A few weeks ago, some people floated a potential bailout plan that would have involved the EIB buying up bonds issued by troubled European countries. That speculation sparked a brief rally in stocks and other risky assets. But now the EIB's own debt is coming under attack. The price of its bonds is starting to fall, and their interest rates are starting to rise. And the same thing is happening to the debt that the European Financial Stability Facility has issued to fund bailouts of countries like Ireland. In other words, it's not just the bonds of individual Eurozone countries that are falling, it's also the bonds issued by the supranational organizations that are supposed to bail those countries out. That drives up the cost of future bailouts, and if the yield surge accelerates, it could even call into question the whole premise of the EFSF. Meanwhile, Spanish 10-year yields just hit a fresh multi-year high, and the price of French bonds is now falling sharply, amid talk that Moody's Investors Service may be getting closer to cutting its AAA rating on that country. And as if that weren't enough, the supercommittee here in the US that was charged with reducing our own federal deficit turned out to be a super disaster, just as I expected. That failure jacks up the pressure on the ratings agencies to downgrade the US's credit rating. To make a long story short, the credit markets are issuing warnings to the equity markets that are as clear as can be. But despite these red flags, the bulls are still betting a lot of money on a year-end rally. Unfortunately for them, it looks like Santa Claus may fail to show up and give the bonus babies their big fat bounce. That just validates the strategy that I've been recommending for months now. Take any profits you may still have from the recent rally, add hedges against downside moves in the major stock averages, and, for your more speculative funds, consider buying select investments that deliver major gains from weak markets. I'm Mike Larson for Money and Markets TV. Thanks for watching.